use this model and practice last time, okay? Then we argue about, say, we test this model. We say whether this model works or not, at least there have to be, the model can capture the real world, what happened. Then we did say, we test one by one, right? We did the first one is test the growth. So growth, right? So company growing, you know that. So when economy going booming, the growth stock will be moving fast. So growing will going higher, right? So growing G will going higher. So G will going higher, then in our this model should be showing up, everything else assuming holding constant, then stock should be going up, all right? So you can see G going up, but G going to be higher, but it's negative, okay? So the K minus G, so then it becomes smaller. So smaller than in the denominator, so whole point P will going up. So you can see that the back and forth, we tested this model can capture the reality is how this each parameter changing. So G if changed, P how they changed it exactly as what we analysis. Okay, so going down, going up, we did last time. Then also we analysis this required rate of return. Required rate, that's why I call required rate of return, because the corporation, let's say stock, right? Very risky. We all say risky. Therefore, risky stock, this must be give you this high yield. If not give you, didn't come in risk, you know, people won't buy. People will feel too risky for giving me these little things. So that's why high risk should be high yield. That's why it's required, because based on your risk, you should give me that high yield. So normally in the future, you're going to learn how to calculate this one, but now give it to you. So that's how corporations require rate of return, okay? And then the difference is this one, right? So this is required. So now, like I say, it's yield, more risky, more higher, this one. So when macro economy, when whole economy is turning bad, so everybody is required rate going up, go to the roof, like a Lehman Brothers investment banking collapse. That moment, all those yields spread, right? So that means risky assets minus the risk-free asset, this spread go to the roof, very, very wide. So this means this guy going higher. So when bad thing happen, when financial market tank, this one going higher. So you can see this one going higher, of course, the stock will tumble, all right? So we talked about last time, these two factors. Next one is, are you going to be, let's say you are JP Morgan, when economy go to like a financial crisis, right? Just imagine that, go back to 10 years later, if we have financial crisis, then JP Morgan paying a dividend of $3, for example. Do you think they're going to be continue pay $3 during the financial crisis?
No, it will drop.
It will drop. Actually, yeah, yes, right, okay. So because they already very low, right? So yes, in the bad time, so normally when they like financial crisis, this is just 1 year, and plus we pay out the so many. So the JP Morgan, all the banks have a lot of capital. They are the top one money they have it. And so normally in a financial crisis, everybody have difficulty to survive the bankings. So if that's the case, they will cut the dividend first. Or most of the time it just stop it, totally stop dividend. They can do that, okay? So therefore dividend will drop. See, when dividend drop, the stock price going down too. So now you can see perfect scenario, when financial crisis down coming, dividend will drop, and the risk going up, required rate going up, and then growth will down. So all these three factors all move in against the price, so stock definitely tumble. So that's why that moment stock is so cheap, you know, tumbling, because all the factor indicated the stock should be dropped. Okay, so that's this model tested. So that's okay. This model sounds good. Model is trying to capture the real world. It's not real world trying to capture the model. Okay, you in the future, when you do research, you go to study graduate level, you will do the same thing. It will be figure out how to do research, capture real world phenomena. Okay, so that's the model, and we talk about how we use the model tested. Okay, so we passing the test. Everything's solid of this model. So we did, okay? So we use the financial crisis, we test each variable and see, can see when the, growth dropped, we know the stock tumble when financial crisis coming and the required rate of return KE going up, the stock will tumble, okay? So we did that, okay? So now from now going forward, we're going to have a theory, a little bit difficult, but after this theory, we're done this chapter, okay? So this last half chapter, a little bit difficult, but just follow me the logic, okay? And then just, actually it's a simple way, it's debate. It's really nothing formula calculation anymore. All what we did is start calculation, multi-period, we're done already, okay? So now we'll go to the next level. So what are we trying to say here is, okay, we're trying to figure out a regular you and me, what do we do in the based on experience? We say expectation, we have an adaptive way. So for example, when you're young, they teach you, don't touch the hot stove, it's hot. You maybe say, I don't care, I don't know. Then you touch it, you learn, okay? You say, oh, stove is hot, do not touch it. So you learn the next time you won't touch it. That's what I mean adaptive, means you learn from the past, learn from the past experience, okay? And then adapt the expectation. So you know next time when you saw the stove hot, you don't touch it. So that's what I mean adaptive expectation, okay? So expectations are formed from past experience only, okay? For example, another way is you calculate the first day go to school. That's how we open up and go to school. If from new location, you figure out your first time you do not know. You take 45 minutes to go to school, okay? And then you feel like, based on what I travel, 45 minutes, I give my 15 minutes room, that's good. So that's what you, based on your experience, then you set up your expectation. So around 50 minutes, I will be able to go to school. So that's what you set up that way. You learn from your experience, okay? So that's what when we talk about expectation. Why we talk about expectation? Because investment is very, very important based on what you expected. And also the Federal Reserve Bank, they want to set up, for example, print money or set up the interest rate. They wanted the world to follow them. They expected, they wanted you, they said they expected inflation to 2%. They wanted you and me, we all expected it to 2%, and then we can working together. But because they never achieve what their level is, they expect it for many years, okay? It never get there. So people right now less believe it. So that's why market a little off from the Fed. That's how we trying to say, build up expectation. And so here trying to learn how expectation build up, okay? So from past, we adapt it, okay? So next one say, okay, changes in expectation will occur slowly over time because the data coming, right? So when new information coming, for example, I use the stove. Okay, now we have new technology. Even you touch a stove, maybe not hot, okay? So that's another thing, right? So you have to adapt and say, oh, next time we know this kind of stove is now hot. The other kind will be this new technology. Or you can talk about technology a lot. So means many ways you can say that, right? So that's what you say. So change in expectation will occur slowly over time as data changing, okay? So because data coming, we will change, adapt our change in the expectation. That's what I mean, okay? So however, people use more than just the past data, okay? Remember when you invest your money to hedge fund, mutual fund, they will give you your statement, okay? They say this manager is very good, make a 20% return last year, okay? And then they did immediately tell you past the return can never represent the futures, means the future return, means not guarantee, you cannot quote them, say, oh, you tell me 20% last year, so then next year will be 20%, why you just make a 5%? Then they will tell you, nobody guarantee your future, but the past is 20%. So that's what I'm trying to tell you. Past is happened, history, okay? But it doesn't guarantee the future. Future could be have new information, new thing, maybe 40% return. So nobody guarantee you had to be 20% return. So that's how I'm trying to tell people use more data, not just the past data, will be, to form their expectation. And sometimes change their expectation quickly. Yeah, people will base on, see, right now we have $1.9 trillion already print out right now, give to you very soon by end of this week, maybe on next week, we'll have the money, right? Yeah, we're going to have it, right? Yes. So now what
Yeah,
happens?
we will have it.
Huh?
I said, yeah, we will have it. They just signed the law.
Yeah, exactly. You're going to have it, right? Now even what? So see how quickly expectation quickly, because next one, people, this one having in hand yet, just pass it. Now they expect next one going to be next one really stimulate the economy. Okay, so that means next money not given to you and me now anymore. It's just next time it's going to be put in economy. Okay, so it's going to be coming very soon. So going to be proposal, whatever comes. Can you believe? You see that expectation change very quickly. Immediately we're looking for our next one. With this one we know over now. So that's how market also like this, very quickly moving to next one now, because the previous one is history right now. So that's, things change very quickly based on new data, okay? So expectation will be identical to optimal forecast. Okay, now here I have to mention that, okay? So first of all, it's the optimal forecast. Do you know anybody doing something like that for optimal forecast? How to set out? What does that mean? Okay, very good. Now tell people more if you want to use model. Very good.
You get data points,
Yes.
and then you run a regression model on it.
Yes.
And then it gives you a bunch of data points, like
right.
alpha naught and alpha 1.
Right.
And you could use that to indicate the future.
Right.
And then there's also, it gives you a residual error term. And
But
you could
yes.
use that to determine a distribution between the correct points.
Very good. So that's a statistical model. Okay, he's trying to talk about this statistical model. Okay, very good. Normally in the real world, a lot of models. Okay, if you can create your own model, most accurate forecast the future. Let's say forecast gold price, forecast the bond price. That'd be great, right? So whole point it is that. So optimal forecast based on all the data. Not only just the past history, also say you project what's going to happen to inflation next year or next period, what's going to happen to the bond market, what's happened to the commodity. You see the silver, the iron already going up, copper already going up, inflation already see from that commodity market. So a lot of indicators you can use. Then you do the best solution forecast. That's optimal, means all you can do. The optimal, the best, all you in, all data, all the system at the current level, all the computers, fast computer, everything in the best possible. You get that result is called optimal forecast. Means just human being can possibly get the best one. That's the one you have it. But use the model, use system. Okay. For example, we say right now, you guys know we're fighting with China is technology war. They already have quantum calculation, okay, very fast, and they already have it. And now we have it, but we're not really there to the mainstream that wide. So we're trying to still trying to fighting the budget to do the high-tech research on the quantum calculation. Because if you have right now, that's hypothetical. If that's a Goldman Sachs, JP Morgan, if they do market trading desk, use quantum calculation, they very fast. Who's fast? Right now, it's just like this. Who's fast, who's win? So the fast means you need to get the best machine, best data, and then get the best result and first execute. That's it, that's a win. So that's right now technology is drive people nuts, right? Because everything has to be that fast, that good, okay? So that's what I say, our expectation, if we're doing good job, we will build in our expectation exactly equal to optimal forecast. Let's say you trust your system, trust your quantum calculation. You know this is the best. You have all the data. So then you will say, this give me 20% return. You will be expected. You will say, it is because my system tell me, my computer tell me, I know my computer is good. So that's what it means, okay, here. So even though a rational expectation, rational means you and me, very logical, fundamental, we rational person, so we rational expectation, okay, I mean logically, okay? So even though a rational expectation equal the optimal forecast, means, remember we just say our optimal forecast is best, then we build up expectation, use the optimal forecast result. So that means I say 20% return of this gold, your expectation will say next period, next year, gold will give me 20% return. Unless you adapt this expectation now, you expect it, okay? So now say, okay, this is expectation becoming rational now. So because you already logical accept it. So rational expectation equal the optimal, okay? Use all available information. Here's the key. Available information means not just the past information. Means it can be people, let's say Fed forecast inflation going to be 2%. That's the forecast data can be there too. All the available information, past and the forecast, everything. Okay, so use all those available information. So even the equal. So means that our expectation matched. However, right, a predictor based on the information available may not always be perfect, accurate. So what I mean, okay, means we already accept 20%, the best forecast optimal return is 20%. We say, okay, we expect going to be 20%. But here trying to say is, even though you're already logically, rationally thinking it should be 20% return next period, but could it be still have an error? What do you mean that? Could it be still something wrong? Why? Because things can change all the time. So when you finish the best calculation, whatever, next moment, maybe, oh, new information coming. You had to keep it. So that at this point in time, maybe didn't capture that one, okay? Could have something wrong, because when you forecast, always have a statistical error, always have some. Impossible unless large, very, very large data. We say data mining, remember machine learning, those all refer to large data. Normally, the larger the better, but still have some error because it's not real. Only true things, real facts happened. That's it. That's it. If it happened, that's it. That means the fact. Otherwise, your forecast still have possible, even the best quantum machine calculation still have tiny error, but still it's error. Okay, it's not so they're trying to tell you, even though do perfect way, you still possible have a problem. Okay, so it take too much effort to make the expectation the best guess possible. So remember we say you do all the calculation optimal, when you optimal forecasting, that's your best guess. What your best guess means based on system give you guess, that means, okay, 20% return. Okay, so that's what you just, no matter what you do, you just do the best. What you can do is the best guess possible. Okay, 20% return. So best guess will not be accurate because predictor is unaware of some relevant information. So it means you still have some, you do not know something else, right? Like we said, two people better than one, because the other person maybe have another information, okay? Or your model may be missing something, anything. Sometimes we even call model risk, because model itself could be wrong, okay? So a lot of things. Here just trying to say you do your best forecast, that's all, okay? And you adapt this, your calculation, optimal forecasting. Then you build up your rational expectation there, okay? So here trying to tell you, we have a variable x, okay? So it means based on all what we just talk about, the optimal forecasting, rational expectation. So if all as human being possible at this stage, so that means this variable can be any variable. If x is interest rate, so you expect the interest rate should equal to your optimal forecast interest rate, okay? So if this one is inflation, so that means you expect inflation based on your optimal forecasting, that inflation, you should be at that equal, because you already do all possible calculated, and then your expectation will be there. So let's think about their equal, okay? So this is easy to interpret, okay? So just follow this theory, logic, okay? Next one. So rationale behind this theory. So what I mean, well, so let's see what they're trying to tell you, okay? So incentive for equating expectation, what we just did, okay, with optimal forecast are especially strong in financial market. So let's see you agree, okay, I want you to do that. So in this market, people with better forecast of future get rich. I want you to tell me why, how they get rich. Who get rich? I want you to interpret because I talk too much. It's your turn. How to say that? Who get rich? Why they get rich?
So in financial markets, if you have the most accurate prediction of where the price will be in a week, a month from now, then you obviously can act on this information and make money.
Yes, yeah, exactly. You know, in the Wall Street, you need a fast and quick. You had to be quick. You say, I did a good job. I did the research forecast, very good, accurate. But you didn't execute it. You didn't do anything, useless. So that's why in the Wall Street is that's why I'm trying to say is a quantum calculation. Wall Street definitely wanted it. They trying to building it right now. Okay, they know whoever calculated fast, quick, accurate, executed, and you grab the first come first serve, right? So you got the first one, you grab the best price, and then you're rich. And that's why you can see why they desperately want to build up those kind of the system. Because you're trading, right? That's how you invest. This is a free market. No matter what happens, this is still free financial markets. So that means you have the best tool, best smart people, you know, you get all the information, then you quickly make decision, you get rich. That's high frequency trying to do, right? People don't even react. They already buy it, and then by the time you wake up, they're selling already. Okay, that's what I mean, okay? In Wall Street, much like this, okay? I'll give you an example. For example, Warren Buffett, right? People like to follow him because he was so big. He's the only, remember I mentioned day one, I said he is the only investor, financial market investor, get to becoming billionaire from invest on stock market. Okay, he's the only one. Everybody else do the corporation, like you know, Mark Zuckerberg or others. They all do the corporation get rich, but he's the investments doing the rich. Okay, so if people follow him, right? So if he buy, let's say he buy the Tesla, tomorrow Tesla will be going up because the news come out, people follow him. But you know, normally SEC requirement is 3 months later disclosure about your position too large transparency, right? So you're too large, you should be a little disclosure your information, but after a certain time. So normally three months later. So people by then know Warren Buffett have Tesla, for example. Maybe he already sold it, but however, because the 3 months later disclosure, you know, he maybe changed the position. So if you follow him, maybe 3 months later already. So that's the whole point, and you know it is a fast update your information, how important it is. You can reach, okay? So you follow not easy. You have to get your own, do your own homework, get your own knowledge. Okay, so next one. So application of the theory of rational expectation to financial markets, we just did, right, where it is called the efficient market hypothesis. Okay, or the theory of the market efficiency. So what I mean here, okay, here's how two camps. People believe market efficient. Okay, if a market be efficient, you don't need to, you cannot timing the market. You cannot say, oh, this price is too cheap, is off the fair value. Means already fair value, market efficient already. So, but you have another camp of the people, for example, those day traders, they don't believe market efficient. If efficient, why they quit a job doing day trader? It because they believe market not efficient. They can based on chart. The chart is historical data, right? And they can see the trigger, not trigger, then they can in and out of trading. They don't believe market efficient. So that means they feel have room, they can make money for living, right? So that's how this here trying to say is, you know, what's that mean, the market efficient? That's why I call hypothesis, because it's still debatable right now, just a hypothesis about market efficiency. Still not really, you see market a couple of days ago tank a lot, and today is up a lot. That means they show you volatility means in the market not efficient, still have room to make money. Okay, efficient means very efficient is good thing is you have you can use index, like I said, ETF or whatever, you can do in that. Okay, so here trying to show you the argument about efficient or not efficient. Okay, so if in the theory, so here I'm trying to say is efficient market, what it's going to be. Okay, so what about the implication about the theory, right? So if there is a change in a way variable move, so if any variable in your model changed, that's an inflation change or job data changed. Okay, so the way in which expectation of the variable are formed will change as well. Means, okay, let's say job data in your optimal forecast model, but job data changed. Because the job data changed, now right now, you are not just thinking about the data going to change. You even think about the method, okay, how to form this, the model. You will change. For example, remember you heard about the people say, oh, do we have a job market structure change? Anybody know what I mean? What do you mean structure change? Anybody know? What do you mean job market have a structure change? Have you heard about this word?
So it's like lasting change that's, for example, due to new technologies. So if you were, let's say, a 19th century weaver and you wove cloth for a living, and now a steam-powered weaving machine comes out, that's a structural change to your field. You're no longer employed.
Very good. Yes. Okay. So that's exactly the point. Okay. So that's what I mean. Okay. So when job, like this time, right, pandemic hit the job market, many people, millions people lose job. Okay. So when we go back to normal, we may be structure change too. Means not like before, let's say you learn finance field, you learn technology field, you will easily get back job. Maybe not, because right now that's a hypothetical. When we back to normal, the AI come in, the 5 years efficiency, the data mining, those AIs, those all come in. We don't need that many people actually. So that's what I do. We will maybe that's just like a Democrat try to proposal, give per person $1,000. We maybe have to give more people stay home because we don't need that many people. That's called structure changing in the labor market. Okay, so maybe fast food don't need that many people flip a burger anymore. They need a machine deliver or machine drone deliver or machine flip a burger. Things could change because this 1 year passed, so you never know what's going to happen. That's called structure changing. Yes, you're very good at job and then maybe don't need anymore. That's becoming so new employment structure come out. So that's things can change. So like I said here is use the example. So before you use job data to forecast in your old model, but since this job data changed, but now the only data changed, you cannot change this data in your old model anymore. Maybe the model need to change too. You see, that's what I say. The way in which expectation of the variable are formed, so the will change as well. So that means how you form this, the format, the form organization structure of this data also change to tell you everything changed, not just data. Okay. Very good. So changing in the conduct of monetary policy. See, now we're trying to say, why we talk about those theories? Because right now tell you, remember this book is your Fed chairman. You have to know the mainstream what's expected. And you try to let them to expect what you do, how you conduct it, how you communicate it. So here you're trying to say is monetary policy have to know these things too, okay? So changing in conduct of monetary policy means how much money put in the economic system. What about the interest rate? Job or labor, remember that two goals, right? Job, full employment, and then the other one is control the inflation. So this is that monetary policy trying to do, okay? So that means target the Fed fund rate. So what I mean here, we're going to learn Fed fund rate, okay? They use monetary policy, means provide money in the economic system or reduce money supply in the economic system. Whole point is target this Fed fund rate. Fed fund rate, it is fundamental interest rate. Remember, I'm showing you in day one in the Wall Street Journal is target rate, and that's the Fed use that rate to control the money supply or economy situation. And then every interest rate is on top of this rate. So this rate is a short-term interest rate. So if this one move going up, everybody else will follow it. Everybody else means every other interest rates will follow going upward. If this interest is going lower, every other interest rates will be follow lower. Remember, you saw so many interest rates. That's what I mean. So Fed try to control this Fed fund rate target, the range. So that's the whole point. They do monetary policy. There's use money to do that. Okay, so now they link to the theory to their monetary policy right now, okay? So here's another one. So forecast arrows. We know forecasts have arrow. You just talk about statistical model. It is to have arrow, okay? So forecast arrow of expectation will on average be 0 and cannot be predicted ahead of time. So what I mean, okay, so they use word, actually this is statistical, okay? So in the statistics, you have so many observation data. For example, mean is next year, you're going to make a 20% return. You could be 21, you could be 18, you could be 19. So also surrounding around 20. So mean is 20, supposed to be. Then you calculate the arrow, those arrow difference, that's average out. Normally, your large number do calculation, statistical large number theory, large number calculation, that's 0, okay? If the larger the better, large do not mean larger, means all the data average out, means arrow will be 0. No arrow means all so big data, okay? So that's why I call large data theory supposed to be, okay? But however, you cannot predict, nobody can predict ahead of time, okay? So, but that's okay, this is statistical. Just tell you, Fed make this monetary policy is impossible perfect. That's why Fed forecasts the 2% inflation for many years. That's their goal, and they forecast and they never reach there. Many people ask question, was the Fed model wrong, right? It is wrong, haven't reached it. They said it can be, but now maybe they're going to be. Why? Because we remember I just tell you, you get this paycheck, you get this check, but they're going to be issue another one. Now that your check by the economic stimulus model, so they're going to go there. Okay, so that's what I'm trying to tell you. Fed policy there. Okay. So I hope you not get lost, right? So here's so many theory, right? I just wanted to give you a heads up. Okay, let's see what it's trying to say. This is we learned that. Okay, so we're going to talk about this hypothesis, right? So rational expectation in the financial market, right? So just follow what we have. We learned this before, okay? So rate of return R, right? So rate of return is your capital gain. This is T is today, okay? Time T is today. Next period is T plus 1, all right? So the difference you see buy the stock today, like I said, buy Apple today and selling tomorrow or selling 1 week later, this is your capital gain or loss, right? That's why plus a cash flow. This cash flow could be like a dividend. If you're lucky, before you're selling, you get dividend, so add on. If nothing, if a bond is a coupon. So either way, just some cash flow if you have it. If you don't have it, 0, okay? So that's what you rate of return. And this is 2 period, right? You buy today, selling next period, okay? Just it's very simple. And the divided by your money, which is you use this money, bring this much. So that's why it's your rate of return, okay? So that's the easy part. Now follow me, okay? Here's go to the real how we argue, okay? So continue with me. So here, see expectation. So what I mean, so because we buy today, we expect that tomorrow or expect the next month, we can sell it. Let's say today Apple trading 122. I buy it today, then I expect it 1 month later. Next period can be anything, okay? Can be next day, can be next week. Just say next, or you can next hour, right? Let's say next month. I expect what the price I can sell. Let's say I expect I can sell 130. So I buy at 120, I expected I can sell 130. So I make $8, right? So I use $8 divided by 122. That's my expected return if I didn't get a dividend, right? So that's why this you expect you can sell because you do not know. You do not know what the price you can sell. That's why it's expected. Okay, so this model is reasonable. Okay, just put it there. That's okay so far. All right. So now we're trying to say is, remember we have X before that formula, X. So this variable is price, right? So it's X, go down here. Remember this formula, see? X is any variable. I say inflation. So expectation should be equal to optimal because we argue so long about the Y expectation equal to optimal forecasting. So X can be any variable. So now we go to X is our price and the rate of return. Okay, so here it is. Okay, so next period, our expected price should be equal to our optimal forecast price. That's how you get it, expectation, right? Remember, your rational expectation, it is based on your best optimal forecast. Therefore, they're equal, right? So that's what they equal. So in the next period, they equal. What do we say? We say if the price you're selling, I say 1 month later you're selling, I expected is 130. My optimal forecast give me 130. That's why I expected 130. Okay, so that's why this one equal. So what do we say is if they're equal, then your return, your expected return should be equal to your optimal return. Okay, so we got it, right? So because this one equal to this one, so then they should be equal. So this piece is okay. All right. Now, what do we say here is if they are equal, that means they must be supply demanding, right? Because if they are equal, then must be in equilibrium. That's what argue say is the equal we know now, but whether it is the optimal forecast is equilibrium. Now we say is. Right now, if you get that optimal forecasting, it is equilibrium. All right. But let's say why it is. What if not? What if not? Okay, let's argue. Okay, let's just leave this one for now and argue here. Okay, let's say now equal. Remember before say they should be equal. So if now equal, this is important piece, okay? So if you now equal, that means, okay, if optimal forecast return, let's say equal to 20% return, equivalent return is 18. So if optimal forecast is higher than this, then what happened? Okay, so that's what happened. So think again, if the return, if your optimal forecast return is 20%, but equivalent is 18%. Let's say if your return, you expected not from now going to future, right? You're going to buy gold. Gold, your forecast, optimal forecast is 20% return. What are you going to do? Are you going to buy gold or selling gold? But you know this is 20% return higher than equilibrium. You can buy gold, right? Because let's say this, okay, everybody say equilibrium is 18. Just assuming everybody tell you 18% it is equilibrium, should be fair value. But now the gold, your model tell you the optimal forecast should be 20% return. Going to be 20% return. Are you going to buy gold or not? You're going to buy gold, right? Because you already find out that your model tell you you're going to be have a 20% return, not 18. So of course you're going to buy. So when you buy, what happened to the price? If you remember optimal model, you focus, I focus, we all focus the same thing is 20% return. So we all buy, right? We all buy gold. So if we all buy gold, what happened to gold? All the price
rises.
Going up, right? Yes, right. So this price going up, right? You buy today, right? So buy today, so this is going up. So if this is going up, what happened to your formula? Look at formula. So if price next, we all buy, we buy this one, buy PT, right? So we say we buy up. So this guy is going up. So this one didn't change yet. So this one going down, right? You agree?
Yes.
Yes. Okay, so then remember we're assuming it's higher. We're assuming if it's high, we're assuming if it's higher than, remember the equal, okay? Rational expectation equal to optimal. So if we assuming this one higher than equilibrium, then we buy the gold. When we buy gold, then turn out that this return gonna drop. Remember the higher, so have the back to equilibrium. So now this dropped back to equilibrium. So now you say, I don't agree. What about if lower? I do the lower. Okay, now we argue back again. So let's say if optimal forecast less than 18%, let's say your optimal forecast equal to 16%, but equilibrium say it's 18. So your optimal forecast is lower than 18. What are you gonna do?
Sell.
Selling, yeah, selling the gold because return lower than equilibrium. Why you buy? You're gonna selling. So when you're selling, we all same model, right? So we're selling, we dropped, price will drop. Watching this equation again, when this price you're selling dropped. So look at this. So this one dropped the negative. So this will be back upward, going up. Okay, going up. That's why market tanked like a couple of days ago. If you jump in, you buy at a lower price, your return will going higher. So now you see, even lower, the return will go back up. So now means what? Both way we argue that they have to equal. Yeah, no way out, have to be equal. So that's why either way, they have to equal equilibrium. All right. So that's what we trying to say. Rational and about this equation is trying to tell you going to be optimal forecast should be your market equilibrium. Okay. And then after that, you can, if market off, you really get a chance to make arbitrage or make a lot of money, like this case, right? If you off, you're higher, then you definitely will be buy. All right. So are we clear, or you want me repeat on this piece? You okay? So we equal now, we argue down. You use the two formula, use this one, okay? So that's why you say you buy, if low, you know what, return low, you're gonna selling because return, remember whole point is about a rate of return. If you expect return gonna lower than your fair value, why you buy? You're selling. Why you wanna buy the something already expensive, right? So you're selling, so this dropped, so then we'll backward, going upward. So go to equilibrium because it's low. So even this one is higher than equilibrium. So everybody desire chasing the yield, chasing return, that means, right? So that means people will buy, and a buy becoming this one, this denominator becoming smaller. So this have to drive. So if it is high, then they dropped. If low and going up, so means in the equilibrium, my market stabilize in the equilibrium. So must be, okay, that's what they trying to tell you expectation and build up. So that's okay. So we got it. So that means if you have good forecast model and you really have pretty much get the equilibrium. And if everybody have same quantum calculation, same model, pretty much the market very quickly go to efficiency, okay? That's why market moves so fast. You can see in the morning market running, blah, 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 then stabilize, like tired. It's not, it's just because they already pricing in and then waiting for new information and they update again like that way, okay? Just very, very quickly just adapt to that information. Okay,
Professor,
so go ahead.
Do you believe in this theory?
Which is theory? Like I said, efficient market, you have to be like what are you, how to say, two camps, all right? If you ask me, my personal belief, you have to see one. To me, it's you have to see one, because like a couple of days ago, market keep down, you know it's a market overreact because just because those 10-year yield, the trigger problem is coming from the bond market 7-year bond treasury auction and didn't selling well. And later on, we have remember we rolling the treasury borrowing and they keep rolling it. So that's why we too many bonds selling in the couple of days. So people feel this bond market really going to be trouble. Now, if one market in trouble, definitely will link another trouble market in trouble, because when bond market trouble, people selling, people dumping, people worry about market. So then they will definitely be a fact to stock market. People use the stock market, use the bond market as a measure too, indication about the stock market. So people worry, so people get out. Plus, when you pricing the stock, pricing any assets, you use risk-free rate discount back, right? Discount factor. So then interest rate, if going higher, price definitely going down. So everybody going to worry, because actually this couple of days, the treasury yield going back a little bit, not that high. So stabilize. So that didn't show you panic that much. So that's why it bounced back a little bit, but depends, right? So that's why new information coming, you're going to adapt again. So that's why, like say, it's a couple of days ago, that's really not in the efficient, but you can see how quickly, you see yesterday, today, I think, this couple of days pricing already, already go back all year high. So very fast, I'm telling you, very fast. So when go all year high, very quickly back to the equilibrium. I mean, it's like efficient. So it means no room for you to get the abnormal return. So you had to waiting for next one. So that's why I say, when you believe, not believe, you have to watching when and how. Even market stabilize, market very quiet down, that means market already efficient. Okay, and then when off that moment, you need but this academia developed this kind of theory, just that you how to interpret the market, like. But however, if your belief normally they build up an ETF. Remember I mentioned ETF. So ETF just based on this theory, say market efficient. You cannot get an abnormal return just by ETF or index, just follow index in the long run. So that's the whole point, is the long run. You're holding long term. That means your even market is, you believe market efficient. That's why holding index. Okay. That's how that works. But it depends, money manager cannot believe it. And they have to make money for living. So they have to looking for something, waiting for opportunity, waiting for market to move. Okay, so that's the thing. Okay, go ahead.
Oh, me?
You have a question?
No, I left my mic on, but a comment I would say is that I believe that I don't know. I don't think every investor takes every information the same.
Yes, that's the whole point, right?
I feel like that in itself is intrinsically, it goes against efficient markets.
Yeah, that it's the whole point. Impossible you get the information or you do research. That's why they don't want to tell you my model. The Goldman Sachs don't want you know their model. So nobody, that's the whole point of secrecy. They don't want people to know what they, especially hedge fund, right? They don't even want to disclose anything. Later on is regulation, SEC force them to disclosure. Otherwise, nobody want to give information. So even same one data, let's say a job data come out, maybe you interpreted say not good. Maybe you're more sophisticated, you see these detail, like we say, or participation rate, it's not there, or children's or teenager working are not there, whatever. So you can, the more sophisticated, more deeper knowledge, the better. You can see more deeply and our experience. So that's why each person see the data differently. So, but the best is you have your own knowledge. You don't want to hear anybody else tell you and then interpret it up, because that misleading you could be wrong. Okay. So better is you have to know it, but then you take a lot of time by time, to research it, to build up the knowledge. Okay. Yours the best yourself, but however, it is, this market have specialty, always has somebody special on certain things, right? So anyway, so that's what the market efficient it is, okay? So now new information. So information in newspaper and in published reports of an investment advisor is readily available to many market participants. So here's actually use simple word is people, the trader, okay, the money manager normally says, buy the rumor, sell the news. So that's basically like this, okay? So trying to tell you, even when you read the Wall Street Journal, you read anything come out and say, oil, gold are going up. They already up. For you already maybe don't have any room to get the high return anymore, because people, by the newspaper come out of news, it's already history news, yesterday news. You want the future could happen. All right. So like, for example, I don't know, you know that for example, Apple, right? Apple saying they're going to build a car, but if nobody news didn't say it, but rumors heard about that. But if you're betting on say, yeah, this may be the truth, you should buy the rumor at that moment, right? Because nobody even say it yet. But once you publish, the whole world know it, you say, oh, I buy Apple now. You maybe can still going up, but it now means now make it a high rate of return than before. So that's just trying to tell you the information when you take it from the public, it maybe not already, already pricing in. Okay, it means it's already reflected in the market price, pricing in already. Sometimes stock market, stock market forward looking, they already pricing in a lot, like right now. If this $1.9 trillion, they pricing in a long time ago, but right now they trying to trade in next one. So that's what it is. They always pricing the future. Okay, so act on this information will not yield abnormal high return. Yeah. So same logic when your buddy friends tell you, hey, have lunch break, I want to chat with you, and then he give you say, oh, my company have this pharmaceutical, blah, blah, blah. And you maybe say, okay, this is the good information, you're going to trading it. First was inside trading. Maybe second of all, he said those information already public information. So nothing can bring the value anyway. But if inside information, you cannot trading anyway, because immediately you get a call, okay? So that's why information you have to handle very well. Okay. So experimental, right, evidence for the most part confirm that recommendation from investment advisors cannot help us outperform the market. So try to tell you, advisor, just like you just asked me, Andrew just asked me, okay? Remember, advisor don't responsible for your return. And so you ask them, they cannot, even they think, let's say they think in their heart, they know Apple gonna be tumbling. They cannot say it. Just the same thing, I cannot tell you, because once things, the wording come out, have to be formally. You could be get a suit. You're could be get a lawsuit or whatever. So that's why they won't say so many things based on rumor. They cannot say that. The other side is okay based on Wall Street Journal, XYZ, like that. So that's why you can see that's certain information you from advisors, they won't give you. That's why I say you better handle money yourself. Nobody else you should trust. You can't, because advisor will dancing around with you. Just don't give you true advisor, because they can't. You can't, okay? Because they don't want to be sued, so they don't want to give you something they feel that's not really concrete. If you guys sued, they have word there say, okay, I didn't say this, I didn't say that. A lot of things like that. So opinion, very personal. Investment, just like you have something very personal. It's each person, like you say, each person has different view. Even one information. Here's one philosopher. I learned this very good way. This is philosopher, French philosopher, very old, 200 years old, right? So it means his history, the philosopher. He said, truth have 4 versions. How you interpret it. So it means you say truth is truth. Why have 4 ways to say yes? So same thing, the investment advisor dancing around tell you X, Y, Z, but just don't tell you the concrete, what the real thing you wanted. Because they can't, because legal bounding there, okay? So that's what they're trying to tell you. Don't trust. It's not don't try. Just you cannot use those information already pricing in when they say those things, okay? So efficient market we're trying to say for the investor, okay? So that recommendation from an investment advisor cannot help us outperform market. Because you want to outperform means you want to beat the index, you want to beat the benchmark. That means you have to be very smart, very good. So that means you just based on the regular information, you can win impossible. So that you cannot do better than other people, because everybody have the same information you have it. So that's what I'm trying to tell you in the stock market. The recommendation You just got to recommend opinion, just get an opinion. You cannot base on that to win. You win, you cannot. So that's why you listen anybody talk, you cannot hunting them, shoot them, but also you cannot trust 100% what they say tomorrow market will go going up. Could it be, but just chances are everything 50-50, right? So hot tip is probably information already contained. Like I just said, if your friend tell you it's hot tip, maybe already there, but if not there, it's inside trading. Okay, so you heard about Marsha's store, right? So she got a jail, she got a punished, just not worth it for several hundred shares of a stock of her friends working at the pharmaceutical, and just that stock are going to be hot. And then she just bought a share. Just she's so super rich, right? Marsha's store, you know, she do the TV commercial selling food or whatever channel. So then you got trouble. So that's here trying to tell you, right? So it means like hot tip maybe not really the information you should use. Maybe you cannot make that much money, but if you do, you also have trouble inside information. Okay, so stock price respond to announcement only when the information is new and unexpected. The word here is unexpected, very, very important. Okay, next month is going to be earnings season again. Okay, you're watching. You just follow a couple of stocks, you will see. So when earnings season, you will feel surprised. For example, Goldman Sachs earning come. Okay, if Goldman Sachs earning, let's say stock already pricing in, say Goldman Sachs earning $5 per share, and stock keep going up, already pricing in. All right. So if Goldman earning report come out at $5 per share, meet the expectation, and then another thing is you have to listen about what they say they're going to do, outlook, what's the year looking ahead. If they didn't say this something good, but earning meet a target, you will see stock going down. Okay, stock will drop because all pricing in all the beautiful information, all the outlook in the future, they pricing in. So you will surprise that why stock down? The earning is okay, it's good earning, you know, the big expectation, blah blah blah. Only good is a surprise good. When this earning, let's say they expect $5 per share, but the earning that day when they report that day announcement, the earning day, they say they make $7 a share. That's a surprise because market didn't price in $7. They price in $5. That's a surprise. And plus they talk about outlook so great or whatever in the future, open up or whatever. So stock will jump another level. Okay, so here's the key point is unexpected. So expectation is very important. Okay, stock market, it is based on expectation. So if you unexpected good, great, stock will jump. If unexpected bad, stock will tumble. Okay, that's how the market moves because that information didn't price in. Okay, so now you say, Professor, is market efficient or not efficient? So before this earning, is efficient because pricing in adjusts everything. But new information coming, surprise means this new information is big data coming out. So that's why they had to adjust it. So very quickly adjust in. So that means that moment when they adjust that moment, before adjustment, that moment market is starting to now efficient. So you can make it up a normal return. So therefore people use the options to betting on volatility. You do not know, right? So that's why you're betting either way. So a lot of people are betting on the earnings season. Earnings season where market are very, very exciting. Okay, right now it's just over the earning and very soon going to be earning April going to come out again. Okay. So you are a student, don't worry about that. You just buy hold. So you buy index, ETF. Okay, because you're too busy. Let's say you're going to be doctor, you're going to be lawyer. You don't have time to follow the market. So what do you do? Just buy ETF. So buy and hold the strategy. Okay.
Professor, is this investment advice?
For which one? Buy hold?
Yeah.
Yes, for you, for student, for the you know, you have other career, okay? You just buy and hold forever, buy ETF forever. You do this way. You do not know which one's good. Buy large growth, small cap, growth, high dividend, you know, certain diversified portfolio and buy hold for, you know, 20 years later, you finish your career, everything, look at your portfolio. you win-win like that, because you don't have time to dealing with the market. Okay, so that's why you should buy hold. If you're a trader, you not buy hold, because you trader means a daily make a living from my market, so you have to trading, right? So that's a different story. Okay, so why the efficient market hypothesis does not imply the financial markets are efficient. Okay, so let's tell you, like I said, it's my camp, right? So some financial economists believe all prices are always correct and reflect market fundamental. So those people believe market efficient. Okay, so that's what I say, right? So they believe you cannot make an abnormal return because all information correct and already pricing in, means the market never wrong. Market already is market. So that means you have nothing you can do. It just follow the market. So that's the financial economics. One camp believe market efficient. Okay. However, right, so price in markets like the stock market are unpredictable. So this has a serious doubt on the strong view on the financial market are efficient. So the other camp believe that market not efficient because market is so volatile. Like this couple of days is volatile. It's a moment to make money moment. If it means efficient, you don't have chance to make a abnormal return. So that's another camp, right? Another group of people. So like I say, you don't have to say I believe this, I don't believe that. You are, like I said, you're busy, you have career, you're going to pursue law school, you're going to pursue doctor degree, whatever you are, you're busy, put the money in the ETF, leave it there, market volatile, tumbling, you don't have to go out, take out. You just don't sell it at the low, that's fine. So, but a trader, they have to working very hard to make a living, and they have to be every day they are waiting for this moment, the moods, the volatilities, right? So that's why you don't have to say, oh, I have to believe this, don't believe this. Not, don't base on that. Just have how to interpret a market. That's two camps of financial economists trying to interpret why market can be, so, everything already pricing in, not that much information available. Market just stay there. Like you can see market during the day, not that much move after. Let me tell the story. In the past, the trader even say, you know what, in the morning, I trading 1 hour. Now I'm gonna go to the roof and have sun baths. And then afternoon at 3 p.m. I come back before closing market. And for 3 to 2, he trading market. 9:30 to 10:30 trading market. The rest of the day do nothing. That's why it is, right? Because you can see in the morning market crazy, moving around, find out what's going on. And in the middle of the day, if nothing news, nothing, they just don't worry. And then end of day come back. So that's how showing your market moving that kind of pattern. Because you will say, oh, during the day maybe market efficient, and then be open market and the closing market at that moment, the market not efficient. So that's how things works. Okay, so that's what the Carlos trying to say. For the last 100 years, if you bought it, you will be super rich. All right. No, don't even say that. Well, for 10 years, you won't have made money, no matter how bad it is. Just you don't even go to 100 years. If you buy Amazon, I think somebody say just maybe 20 years ago, buy $8 a share, you're already rich now. Look at the Amazon stock price, right? So that's how you just buy. Well,
Professor,
you cannot hold 100 years, right?
So if
okay,
you
go ahead.
if you have the efficient with the efficient theory, that means there's no bubbles ever. If the efficient market theory.
Well,
that means
you
Tesla's in a bubble and
no, you can be bubble. You know why? Because remember, efficient means put price in all available information. So let's say bubble information means like we have so price very high, right? So all information people keep buying high. People believing because you pricing in the future possible. Your outlook so rosy. So stock can still going up. Then only thing is if you believe efficient stock pricing right, maybe you don't have that many short seller, right? You don't short because why you short? You short believe like I said, believe the bubble. You believe the bubble, then that's not a short. You can short, right? You want to short a market because you believe it's a bubble. But the efficient market maybe don't believe it's a bubble. Means pricing. They believe the information. It is all reasonable, correct. Remember, they say it's correct. They didn't say so. It's correct means if it's a bubble, they believe correct. So anyway, this is the behavior finance, last slides. Okay, so all what we talk about to say is, this efficient, not efficient, just argument. Okay, two group people can be anyone you believe in too. However, behavior finance is a very important new field for financial major because talk about human being behave, how they behavior in financial markets. Okay, people are fair, people are dare, those things. So lack of short selling. So remember you just said bubble. No, so people have different view, like you and me. Like if you are very brave or you expert, you see these 2 days already, what do we say, the historical high again in these two Dow Jones and also NASA, right? No, the technology. So tech stock. So if you're there, you're short selling, right? You short because you will believe they're going to back because it's too high. If you believe, right? So you're going to short. So market is a free market, allow you to short, okay? But however, I see when we talk about short, we need to mention this. You know why this couple of days the game stopped going up again a lot? You know why?
Yes. The thesis is that it was over shorted.
Okay.
So like the short interest at one point was over 100%, meaning there was more shares shorted than float. So it's a crowd of retail traders trying to squeeze the shorts.
Right, that's the short squeeze one. So this couple of days, what happened? Going up a lot this couple of days. You know what's the news story? See, that's the good thing. It's a news story. That's a short squeeze is a couple of months ago. What about yesterday? Couple of days ago, they go back up a lot. What happened? Okay, what happened is because they are trying to remove the short selling. Okay, so I'm trying to set up a rule is on the limit on the short selling, and that's why it means you cannot. You limit the rule means like reduce the short selling capability. So means the stock can only going up or cannot going down that much because they don't allow that many short selling. So that's another way is making the stock going up. So happy, just keep going up, But don't touch that stock. That stock is a crazy stock. Okay, like a wild cats cannot do it. Means it's just really, really crazy. Okay, so your fundamental analysis, fundamental investor, you're too busy as a student or any career, just a fundamental way to invest. Okay, so behavior finance here is trying to say. Now remember we said short selling. Okay, you see if lack of short selling, so you can see that we cannot be like this GameStop situation. They're trying to limit on the short selling. It's not a good thing. It's not healthy. You should let the market free, set up the rule and let the market free will do what they want. If you want to short, just short. If you just one way direct, do not allow short selling, the market go to one direction, like a GameStop, going to go to bubble. There's a bubble create. And if tomorrow bubble, then next day going to be crash. You don't want to go to bubble because then we'll become in trouble. We don't want to. That's why this couple days market tank is a good thing. It's healthy. That means we're far from a bubble. Then if we go to continue going up, we're going to worry. Day by day going to worry, okay? Next one is large trading volume may be explained by investor overconfident. You know that, okay? But that's what they have. You have a broker stock or a broker account. You can see the trading volumes. Okay, you can see how many stocks going up, how many going down, a long short put call ratio. Those things that can tell that people overconfidence. All right, so because too many people buy, okay, that's some more confident, more you're scared. Like this couple day 1, day 2, boom, day 2 already beat the historical high. So that's very fast. So overconfident we'll see, because once right now, maybe just from the bottom, from the tank, like Tesla already down 20%. That's bear market already. So technology almost go to the bear market and then recovered. So that's why people still have room to run, okay? Because just back up, all right, not bubble yet. So stock market bubbles may be explained by overconfidence and social contagions, okay? So I want to tell you the story. If you read it, once you summer break, you read 1929, that's a financial crisis, okay? And this gentleman, he was a trader. He was doing 1929, that moment stock market very high, a lot hot. A lot of people trading in that moment. And I think his name is Jesse Lieberman. He was a big short selling trader by then, 1929. And then he's make a lot of money from short on the market. So he went to do a shoe signing. You know, by then it's people dressing very nice in Wall Street. And he went to shoe shining, sit on a chair, and the same guy always shining his shoes. So they know each other, and then they just chat, talk, and then he finds out that his shoes signing, that person can talk so sophisticated about stock market. XYZ doing so well. He went home. He do first thing just short the market. He feel the market bubble. Remember then, we don't have technology, we don't have information, we don't have chit chat, we have nothing. So he based on that information and can sense the market too hot. And he's short, and he did make millions, that more millions allowed. He make a lot of money from that financial 1929 crash. 1929, that moment is the worst, the greatest depression, the worst one. And he made a huge money, okay? He's a success from there. But I won't talk about the rest of his life. I don't want to mention it because you got to read it, okay? So we done this chapter. So we finished it now. Next class, we're going to review and then exam. Any question about your exam? It's a random question, random answer. Read a book. Read a book is the best, and practice understand everything in the slides. PowerPoint is for me. But understand it inside out to be great, and read a book, know familiar your material at least, and you know which question, of course, open book, right? So, but still your timing is very, very important, okay? Any question?
Professor,
Okay.
on Blackboard, it says the system will lock you out if you're late to the exam. Does that mean if you start the exam 1 minute late, you're going to get locked out?
I don't think 1 minute. I don't know system give you how long, but don't be too late.
Okay.
I don't think you can later even more than 10 minutes. I don't know how long, but I think it's the system will block it out.
Okay, thank you.
Yeah, but make sure you have a computer system and internet connections. Make sure you're quiet. Don't let your family member interrupt you, and make sure connection very important. Don't be say, oh, my internet not working, I be logged out. Like I said, if you have those trouble, it's not me. We cannot find a help desk. You know, I don't know how we're gonna have services. So that's why don't have be trouble by then. Okay. Any other question? All right, so we're good. And then after this, you just